Joining me right now is Sound Income Strategies founder and CEO, David Scranton. And David, it's good to have you this morning. Thanks so much for joining us.
Oh, it's my pleasure.
What have you gotten from these retail numbers and from Jay Powell yesterday in terms of where we stand today with the market valuation as well as growth expectations?
Well, as far as retail numbers, when you talk about, I know you mentioned Lowe's, and the interesting thing is that Lowe's is going to make, whether they meet the numbers or not, they're going to make their stock do well. They're dedicated throughout 2019 to doing more share buybacks, even if it means taking on more debt. The real concern is the economy, and when their big competitor, Home Depot, has better margins, if the economy starts to go into a recession, then clearly the stronger competitor with better margins is going to do better. And if you read between the lines with Jay Powell's announcement yesterday, he's concerned about recession. And he should be. You know, it's funny, but the 800-pound gorilla that nobody's talking about with the Federal Reserve and why the Federal Reserve really finally stopped hiking interest rates is that they inverted a good part of the yield curve. You know, you've got a one-year Treasury right now at 2.53, a 5-year at 2.43, and a 10-year at 2.63. One more hike, and now he's inverted the 1-year and the 10-year. So I believe that's the real reason why they can't make that move to get rates higher at this particular point.
Yeah, I mean, we were all waiting for an inversion between the 2 and the 10-year. That never happened, but you're right about the 2 and the 5-year. What are the implications there?
Well, the implications, all of a sudden, banks don't want to lend as much anymore, and that's already starting to happen. You know, the issues were that throughout 2018, the bond market, every time Mr. Powell will get on television and say he's going to raise short-term rates, the bond market would oblige, and there'd be a bond sell-off, and long-term rates would advance ahead of short-term rates, allowing him to raise those rates. In December, they finally said, enough is enough. The economy's not strong enough to justify higher long-term rates. And that's when he came out. He again announced a short-term rate increase in the federal funds rate, and all of a sudden, there was basically a flight to quality, and the 10-year Treasury dropped by 50 basis points. And that sent a strong message that enough is enough. And, you know, there's a reason that everyone says, you know, the bond market tends to be a little smarter than the stock market. So I think we and he should listen to what the bond market's trying to tell us.
We want to just bring out, we are waiting on earnings this morning, and we've got earnings hitting the tape right now. We got an earnings beat to report, but we're also looking at the ramifications of Jay Powell's testimony yesterday. He spoke to the Senate Banking Committee yesterday. He's going to speak with the House today, and the head of the central bank commented on the expansion. Let me play this soundbite, get your take on this. Listen to this.
Mm-hmm. We want to use our tools to sustain this expansion and keep the labor market strong and keep inflation near 2%. That's exactly what we're trying to do. And so we look around and what do we see? We see a labor market that is strong and continuing to strengthen. Job creation is strong. Wages are moving up. So that's a very healthy thing. The committee has decided that with our policy rate in the range of neutral, with muted inflation pressures and with some of the downside risks that we've talked about, this is a good time to be patient and watch and wait and see how the situation evolves. 2017 was a year of synchronized strong growth really around the world. It was a very good year, and we were feeling a tailwind from that. That has now turned into a bit of a headwind for us. Our economy, though, I think the outlook for our economy is still a favorable one, still a positive one, but nonetheless, this will be a headwind.
Your reaction, David, you're seeing real slowdown. I mean, the European estimates in terms of growth in Europe are 1%, David. What did you take away from that?
Well, you know, you always have to decode, if you will, the Fed's language. And, you know, what he's trying to say is that he's trying to be an optimist. He's trying to be a Fed, you know, economic cheerleader, if you will. But at the same time, he's saying, you know, there are some signs out there if you read between the lines. And more economists now are saying they're concerned about recession in 2020, and some are even indicating the end of 2019. So when he says he's willing to use whatever tools the Federal Reserve has, you know, you have to be open to the possibility of that the next move in interest rates might just be downward and not upward.
Because of the slowdown in the economy. Real quick, would you be putting new money to work here, or do you want to hold your powder dry given what you're expecting on the economy?
In the stock market, I think right now cash is king. One has to be extremely cautious. In the fixed income markets, though, I think the headwind is pretty much subsided, and there's still some really good opportunities in fixed income.
David, thanks so much. Thanks for joining us this morning. Good to see you.
Same here. Thank you.
David Scranton joining us.